Good day, Junior Techie. This is Mrs. Tamalon, and today we're going to look at Activity 3, Adjustments and the Post-Adjustment Trial Balance. Now, because this is such a large activity, we're going to split it into two. We're first going to look at the adjustments and the calculations for those adjustments, and then the general journal entries, and then in the second activity, 3B, we will look at the Post-Adjustment Trial Balance. So, let's jump right in. First of all, what are adjustments? So we have year-end adjustments, which depreciation, which we covered in the first video, and now in the second video we add adjustments for income and adjustments for expenses. So income adjustments is accrued income. Now accrued income is income that has been earned by the business, but that has not yet been paid by the customer. So in other words, we've already rendered the service or given the goods, but we still need the money for it. And then we have income received in advance or deferred income, and that is exactly the same thing. Income received in advance is just more to write down, so I just prefer calling it deferred income because it saves you time and it's less to write down, but you can use any one of the names. So income received in advance means that we've received the cash but we did not render the service yet. So for instance, rent, that's a good one. So rent is always paid in advance. So we've already received the rent for next month, but they still need to be able to live or use that space for the month coming up. So how do we record this? So in our general journal, when we have an accrued income, we have to debit accrued income because that's an asset because we still need the money. And we're going to credit the income account, adding it to the income because it's income we need to record for this financial year. So we have to add to the income account. How do we record accrue or income received in advance? This means we've received income that is not meant for this financial year. So that's a liability because we still owe them the service. So we're going to, income received in advance is a liability because we owe the money for the service and it's not this year, financial year's cash. It's next financial year's cash. So I need to minus it off my income. So the income account is overestimated, so I must minus the income account or debit the income account. Then the expense adjustments, we have accrued expenses and prepaid expenses, so similar to the income adjustments, but just for expenses. Accrued expense means we have incurred the expense, in other words, we owe the money for whatever, water and electricity, for the insurance, for whatever. We did not pay it yet, but we should have. So we need to record that as the current year's expense. And a prepaid expense is meaning that we paid it in advance. So a good example there is insurance. Insurance is always paid in advance, so you pay now for cover for the coming month. So you've paid it in advance. So it means that your expense is overestimated for the current financial year, and you have to minus it off the expense. So if we look at the recording, accrued expense is an asset. A liability because it's something that I should have paid, but I didn't. In other words, I owe the money, so it's a liability. And then the expense account must increase because it's this financial year's expense. And then prepaid expenses, I paid the expense in advance, so they owe me the service. Therefore, it's an asset to the business, and the expense account is overestimated, so I must minus it off the expense. So in other words, adding it to, minus it off the expense. So next, adjustment is inventory adjustments. So when we have inventory, we have to make sure that our inventory that we physically count matches the inventory that I recorded on my books. So when we have trading stock, I have to do a physical stock count and compare that to the amount recorded in my books. Now, most of the time, because of human error, because of stock going bad, because of things getting stolen that you're not aware of, the two amounts will not match. So we then can have a trading stock deficit. So that is when we record more on our books than what we physically counted. So there's less in our storeroom than what we actually recorded. Then there's a deficit. It can also happen that there's a surplus. In other words, we count more than physically than what we recorded on our books, because maybe there was a delivery of stock that we haven't recorded yet, and we have to then add it, so that eventually in our ledger accounts our physical stock matches the value in our books recorded. So for trading stock deficit, I will debit trading stock deficit, because that's an expense if I had to record less in what was physically counted, and I'll have to minus the trading stock account to make it the same as the stock count. And then for the surplus, I will have to do the opposite, add it to my stock account and create an income, because now there's more stock than what I imagined. Secondly, the other type of stock that I can have is consumables. Now that can be anything from your stationery, your cleaning materials, the milk for the tea and coffee, whatever it might be. That's consumables. Packaging material sometimes is also recorded as consumables. And you physically count how much stationery do I have left over? How much milk do I have left over? Is there a new tin of coffee still in the cupboard? Whatever. And if it's there, that means it's an asset, because I can still use it in the next financial year. But with consumables, when I purchase it the first time, I record it straight off as an expense, because the assumption is I buy enough to use immediately. But obviously, we know that that doesn't happen. So with consumables, we have to make sure, yet again, that we adjust the expense account and record what we have on hand at the end of the financial year. So we're going to debit consumable stores on hand, which is an asset, and credit the consumables, because our usage is now overestimated, and therefore we have to make the consumables expense account less. Then next, we can have other adjustments. Now these other adjustments come from previous chapters, so that had specifically to do with debtors. So it's bad debts recovered, insolvency, so when a debtor becomes insolvent and you get money from the estate, interest on overdue debtors when you charge them because they're overdue on their account, loss in stock because there's theft or fire or whatever it might be, adjustments because of the bank statement. So in other words, there's bank charges or interest on overdraft or whatever that hasn't been recorded in our books yet, but that we still need to record. And then finally, corrections of errors. Now, I'm not going to go into any specific details other than what you see in front of you, because we've discussed this in previous modules in detail. So if you can't remember one of these things, please go back to the previous modules and go and double check on it. So this is now your building blocks. If you don't understand any of these adjustments, you're really going to struggle. So I suggest that you go back and revise this section if you struggled with it previously. So now we get to the activity, and they give us the pre-adjustment trial balance of JT Suppliers on the 31st of October 2020 and 2022, and they give us the figures. So these figures are pre-adjustments, in other words, before I had to adjust it for the end of the year. And why do we do adjustments? Remember, we have to adjust so that we can record the most accurate income or your income and expenses, so that we can record the most accurate profit or loss for the financial year. And that is why we have to do adjustments. So they give us the balance sheet account section, and then the nominal accounts section, just because I can't fit everything onto one screen. And then they give us required, and they ask us analyze the adjustments under the headings on your answer sheet, using assets, equity, and liabilities, and indicating a plus with a increase with a plus and a decrease with a minus. And then prepare the post-adjustment trial balance. Now in this activity, we're going to focus on 3.1, the analyzing the adjustments and looking at the entry in the analysis. So first of all, if we look at each adjustment, we have adjustment number 1, depreciation on equipment at 10% per annum on the diminished balance method. Then for vehicles, number 2, the vehicle is new and was bought halfway during the year. Very important, halfway during the year, because now we need a time adjustment, 6 months only, and depreciate at 20% on cost. Commission of 4,000 Rand is owed to JT Suppliers. Now, we are JT Suppliers, so someone else owes us commission for things we sold on their behalf. So this is an accrued income. So we're going to debit accrued income and credit the income account commission income. Rent of 5,000 Rand is paid by the tenant monthly in advance. So rent income, because the tenant pays us, so it's rent income, is paid in advance, so it's income received in advance, so or deferred income, which is a liability. We owe them the usage for the space, so our rent is too much at the moment, so we need to take away 5,000 Rand, because that 5,000 Rand is only for next financial year. Then water and electricity account for October has not yet been paid, so not yet been paid must, and because water and electricity is an expense, it is an accrued expense. Number 6, 1,000 Rand was paid in October for an advertising that will run on the local radio station in November at the start of the festive season. So we paid in October for something that we will only get in November. So therefore it's a prepaid expense. Then number 7, trading stock account at the end of the financial year reflects the following, or stock account, refers the following on hand. We counted our trading stock and we have 242,000, and our consumables we have 800 Rand left. So the 242,000 we have to compare with the book value in our trial balance, and the consumable stores is what the expense is over, what is left over that we can still use next year. So that's not usage, so the expense is over with 800 Rand. So I need to minus that off my expense and add it to consumable stores on hand. Then interest, number 8, interest on fixed deposit is received each quarter. A quarter is 12, for 12 months is, or a quarter of 12, is 3 months. Why do I say a quarter of 12? Because we work with 12 months. So every quarter means every 3 months. And the interest for the last quarter has not yet been received. So interest on fixed deposit is an income. Not yet received means it's accrued. So accrued income. And then lastly, the internal auditor found that bank charges of 440 Rand had been incorrectly debited to sundry expenses. So this is a correction of an error. So you have to remember, draw your T accounts. So now we're going to break it down and look at the calculations for each of these adjustments. So the first one, depreciation on equipment at 10% per annum on the diminished balance method. So the formula is cost price over 1, cost price minus accumulated depreciation over 1 times rate over 100 times months over 12. Now, where do I get these amounts from? These amounts will come from your pre-adjustment trial balance. So if you go back and you look at your pre-adjustment trial balance, you'll find the cost price for equipment, which is 250,000, and your accumulated depreciation for equipment is 60,000. So 250 minus the 60,000. Rate they gave us is 10%, and they didn't say halfway, so we can assume, or they didn't give us a specific date, so we can assume we've had this for the entire year, so 12 over 12, and that gives us 19,000 Rand. So that is the total depreciation for equipment for the current financial year. Then depreciation on vehicles is 20% per annum on cost, but we bought it halfway during the year, so that's important. So our formula is cost price over 1 times rate over 100 times months over 12. And yet again, where do I find the amount of 320,000 Rand? From the pre-adjustment trial balance, you will see that we have 320,000 Rand for vehicles. Rate is still 20. Halfway, half of a year is 6 months, so 6 over 12, and that gives us 32,000 Rand. Then we move on to calculation. Now the other adjustments we don't need to calculate, number 3, 4, 5, 6, 7, because you just use the amounts as is. And the next one we have to calculate is the interest, number 8. So interest on fixed deposit is 8% per annum for a quarter, because they say the last quarter has not yet been received. And as we said, a quarter of 12, because we use 12 months, so a quarter of 12 is 3 months. That is very important to understand. So what is our formula for interest? Always simple interest. So it's the invested amount over 1 times rate over 100 times months over 12. Simple interest calculation. Yet again, where do I find the amount? The 50,000 Rand you will see next to fixed deposit on the pre-adjustment trial balance. 8%. Now, where did I all of a sudden get the 8% as well? It wasn't, if it's not mentioned in the adjustment, then you will see next to fixed deposit on your pre-adjustment trial balance, they will always give you the percentage. So 8% for 3 months, because it's a quarter of a year and a quarter is 3 months. Therefore, 1,000 Rand of the interest still needs to be recorded. Or you could have said your 50,000 times 8 over 100 for the entire year gives you 4,000 Rand per annum. Divide by 4, because a quarter is 4 pieces. That gives us 1,000 Rand. Or you can even have said 4,000 versus the 3,000 we've already recorded. Now, how do I see the 3,000? This 3,000 will be the interest on fixed deposit amount in the nominal section on the pre-adjustment trial balance. So I should have recorded 4,000, but I recorded 3,000. So there's a difference of 1,000 Rand that is still to record. So that's just different ways of looking at the same answer. Then we have to analyze the transactions. In other words, identify account debited, account credited, and then give the effect for a plus and a minus for assets, equity, and liabilities. So number 1 was the depreciation for vehicles. So we debit depreciation, which is the expense, and depreciation on equipment. So we credit accumulated depreciation on equipment, which is a negative asset that will increase. A negative asset meaning credit. That was plus. So now we have to say, okay, first of all, very importantly, a negative asset that increases is a minus on assets because it's a loss in value. So always remember that accumulated depreciation is a loss in value, so it's a minus on assets. It's a negative that increases, a minus that pluses. So a minus times a plus gives you a minus. That's why I use a minus there. And remember, an expense increasing decreases our profit. So it's a minus on owner's equity as well. So now, does our equation balance out? Yes, because assets minus 19,000, equity minus 19,000, liability 0. Both sides of the equal sign is correct. Number 2 was the depreciation for vehicles. So I will debit depreciation again, but I will credit accumulated depreciation on vehicles. Yet again, a minus times a plus is a minus. It's a loss in value. So minus the 32,000 Rand for assets, and then an increase in an expense is a minus on equity, because the more the expense, the less the profit. So 32,000 there, and yet again, our equation balances out. Number 3 is accrued income for commission income that is still owed to us. So we debit accrued income, an asset, money that has to come into the business, and I have to record the income for the current financial year, therefore plussing the income. So I'll plus assets with 4,000 Rand, and I'll plus equity with 4,000 Rand. Then number 4 was our rent income that was still due. So in other words, the tenant still owes us the money for the rent. So rent in, apologies, ladies and gentlemen, they don't owe us, they paid it in advance. So the rent income was paid in advance. So the rent income figure is too high because it's income for the next financial year. I cannot record it now, so I must minus the rent income, therefore debiting rent income. And deferred income is a liability because I still owe them the usage of the space. So liability. So I'll minus 5,000 Rand from equity and I'll plus 5,000 Rand in liabilities, and that then gives us a 0 on the equity and liability side of the equal sign, and asset is 0, so our equation still works out. Then number 5, water and electricity was still needing to be paid, so it's an accrued expense which is a current liability, and water and electricity must plus. Remember, if we have a plus for expense, it's a minus on equity. So I'm going to minus 5,200 Rand off owner's equity and plus 5,200 Rand for liabilities because I still need to pay the municipality the money. I owe them. Then number 6, we prepaid the expense for advertising. We paid in October for an advertising that will only appear in November. So prepaid expense is an asset because they still need to run the advertising for me. And then advertising expense is over because I already recorded it as a current expense, but it's not for the current year, it's for the next year. So I must minus it off. So be careful now because now we have an expense that minuses. So that is a plus for equity because it's taking away less of my profit. So it's, in other words, less expenses means more profit. So plusing the equity there. And prepaid expense will plus 1,000 Rand for assets. Then 7, we're going to do in 2 parts. First, the trading stock deficit part, and then the consumable stores on hand. So we did a stock count, and we saw that we have trading stock, and we have to compare that to the value of the trading stock counted to the value on my books. And I see the trading stock, there's a deficit. And how do I get that deficit? I compare the 242,000 with the amount on my trial balance, and I see there's a difference of 4,000 Rand. So I need to minus off 4,000 Rand because I counted 4,000 Rand less than what I actually recorded on my books. Then consumable stores, I still have left over, so I have on hand. Now, very importantly, the moment you say on hand, it becomes an asset. So this is now plussing. And the expense is now over, so I must minus off the expense. Because it's not this financial year's expense, I can still use it next financial year. My assets will now plus. Remember, when I have an expense minusing, it's a plus on profit. So plus on equity. So plus 800 Rand for assets, plus 800 Rand for equity. Number 8. We had accrued income because interest for the last quarter was not recorded yet. So I'm going to debit accrued income and credit interest on fixed deposit. So that is a plus for assets and a plus for equity of 1,000 Rand that I still need to record. And then number 9, it was a correction of an error. So what was the error? The fact that we recorded 440 Rand in sundry expenses, but we should have added it to bank charges. So yet again, draw your T accounts and look at the error. So the error was the 440 on the debit side of sundry expenses. So I must take it away. So credit sundry expenses and add it into bank charges. So debit bank charges, expense plusing, credit sundry expenses, expense minusing. So we have a plus and a minus under owner's equity. So technically the effect is 0. And that is the end of this activity. Now, this is very overwhelming, but remember, stay calm. Study the rules for each adjustment. So make sure you know in each adjustment what is the debit, what is the credit, and does that debit mean plus or minus? Does that credit mean plus or minus? So, for example, the accrued income, we will debit accrued income and credit the income account, plusing assets, plusing income. So make sure you're going back to your theory and study this off by heart. It will just make things a lot easier. Keep practicing, because practice makes perfect, and then you will see you will survive and manage well. Activity 3, Part B, the post-adjustment trial balance, is what we will look at next. Thank you and goodbye from Mrs. de Mailon.